Hey everyone, welcome back to Finance Sphere. The crypto market experienced a massive, sudden surge. If you're holding right now, you're likely feeling the euphoria. And if you're sidelined in cash, the FOMO is definitely setting in. But while the retail crowd is distracted by green candles, the smart money is looking deeper. We need to understand what actually engineered this liquidity injection. And more importantly, what does the broader market structure tell us from here? We're looking at the macro landscape, on chain metrics, and technical charts to figure out exactly how to navigate this market. The primary catalyst behind this pump wasn't retail demand, it was a calculated intervention by the US Treasury. As the yield curve steepened and long term yields continuously surged, the Treasury made a sudden move. They announced they are effectively quadrupling their long term nominal Treasury buyback operations. Right on the heels of that, the White House hosted a historic digital asset summit. Led by President Trump, it gathered the heads of the SEC, CFTC, Wall Street Titans, and key crypto industry leaders. The result was an immediate, explosive rebound across Bitcoin and the broader crypto market. In my last video, I pointed out a bullish divergence printing on the 4-hour chart. I also noted that a recovery in copper prices could soon spill over into a crypto rally. In line with that macro setup, crypto just surged 10 to 20% in a matter of days. Historically, August and September bring seasonal weakness for risk assets. However, just as we saw Bitcoin take a major, unexpected hit last October, seasonality is missing the mark once again. Right now, technical chart signals are proving to be a much more reliable guide for navigating this current market. This indicates that the market is moving much faster than its organic pace. The question now is how to position ourselves moving forward. Let's start with the Treasury's policy move that sparked this surge. For context, a Treasury bond is essentially a formal IOU issued by the US government when it borrows dollars, promising to pay a fixed interest rate known as the coupon, and return the principal at maturity. For example, if a bond locks in an annual 4% payout, that rate stays fixed until the end. Creditors buy these newly issued bonds in the primary market, and investors trade them among themselves in the secondary market. But market yields fluctuate daily based on supply and demand. When market yields spike, those older fixed coupon bonds become far less attractive, driving bond prices down. Conversely, when yields fall, bond prices rise. So, what happens when the US floods the market with massive debt issuance? An overwhelming supply of bonds depresses prices and pushes market yields higher. Recently, we saw both 10-year and 30-year US Treasuries experience aggressive, destabilizing spikes. Whether driven by ballooning debt, credit downgrades, or foreign nations scaling back their purchases, one thing became obvious. Investors had clearly lost their appetite for long-duration treasuries. With yields spiraling out of control, Treasury Secretary Scott Bessent stepped in. The Treasury announced an aggressive expansion of buybacks targeting 10 to 30-year nominal treasuries. They increased the purchase cap per operation from a maximum of $2 billion to a minimum of $4 billion and doubled the frequency. Here is what that actually means for the market. The U.S. Treasury stepped in as the buyer of last resort for long-duration debt the private market didn't want. This massive injection of artificial demand forced bond prices up and pulled yields down. Lower yields mean cheaper borrowing costs, acting as a direct liquidity IV drip for the financial system. Naturally, the hyper-liquidity sensitive crypto market reacted instantly. The 30-year yield slid from 5.216% to 5.196%. Capitalizing on this engineered liquidity, the White House perfectly timed the leak of its digital asset roundtable. Dropping pro-crypto headlines exactly when macro liquidity expands is a familiar playbook. But what caught my attention was the guest list. Historically, these meetings were dominated by Bitcoin miners and pure-play investment funds. This time, heavyweights from the altcoin ecosystem, like Coinbase, Ripple, Chainlink, Uniswap, and Solana, sat alongside legacy giants like NASDAQ and the DTCC. That guest list sent a pretty clear message. The US government and Wall Street are actively laying the groundwork for on-chain finance. That includes tokenized securities, or RWAs, and a broader derivatives infrastructure. It's a strong hint that altcoins are being positioned for the spotlight in the upcoming expansion phase. While the Treasury is pumping liquidity, the Federal Reserve is playing a completely different game. The July FOMC minutes reveal that Fed officials remain deeply anxious about inflation, with strong anti-Trump sentiment echoing inside the Fed ahead of the midterms. The newly appointed Fed chair is walking a tightrope. Historically, new Fed chairs oversee significant market corrections within their first 2 to 3 months. Right now, the Treasury's liquidity band-aid and the Fed's pushback are pulling risk assets in opposite directions. Yet, if we look at the actual macro data, the inflation picture is nuanced. The spillover from war-driven oil spikes into broader CPI remains contained. In fact, trimmed mean inflation metrics, often highlighted by figures like Kevin Warsh, are actually decelerating. We are seeing that same trend mirrored across major global economies. On the labor front, headline non-farm payrolls look positive, but there is a major shift beneath the surface: the explosion of AI-powered solo entrepreneurs. Traditional economic models assume new businesses mean mass hiring. Today, autonomous AI agents allow businesses to scale with near zero human headcount. If real employment isn't organically expanding and inflation upside is capped, a Fed rate hike right now risks freezing market liquidity entirely. Furthermore, as AI productivity scales, it will introduce massive deflationary pressures. The Fed knows this. That makes their hawkish jawboning a tough trigger to actually pull, as reflected in the latest CME FedWatch data for September. Consequently, with the downward market structure already broken to the upside, we should expect a healthy correction to this rally sometime between September and October, driven by these exact factors. As I mentioned in the previous video, I believe the smartest play right now is to keep scaling in with a strict DCA strategy every time the price taps those major moving averages. Now let's take this macro picture and compare it with what's happening on-chain. Despite the explosive price action, long-term holders and miners have actually been distributing into this strength. The miners' position index spiked, indicating miners are selling rather than holding for higher prices. Furthermore, spot demand volatility remains muted. This tells us a critical truth. This sudden pump was largely a cascading short squeeze driven by derivatives and leverage, rather than organic institutional spot accumulation. Therefore, up to this point, organic spot investment demand hasn't seen any significant uptick. Instead, what we are actually seeing is players distributing and cashing out their profits into this strength. For this reason, if this breakout is going to transform into a long-term uptrend, it remains true that we still need to see more structural evidence on-chain. Moving to the technical charts, a massive shift just occurred. Bitcoin decisively broke above the macro descending trend line that had suppressed price action since October 2025. Now we need to look at potential targets. Applying a Fibonacci retracement from the 2025 cycle top to the recent bottom, our minimum target sits at the 0.382 level, roughly the $82,000 to $84,000 zone. If momentum pushes to the 0.5 level, we're looking at $92,000, where significant volume is clustered. When the price dropped from the $74,000 region, it plunged straight down without building any significant volume or liquidity. Because of that void, Bitcoin's recovery up to this point has been relatively smooth. However, the $82,000 to $84,000 region represents heavy order book resistance and coincides precisely with the 0.618 Fibonacci retracement level. We should expect fierce selling pressure there. Algorithmic valuation model shows price bouncing cleanly off the macro lower band support and weekly moving averages, making short-term upside highly plausible. But it won't go up in a straight line. We can also look at the copper to gold ratio. Dr. Copper signals real economic expansion, while gold signals fear. A rising ratio means institutional capital is rotating into risk-on mode. Right now, this ratio is pulling back after a strong advance. Since it historically leads Bitcoin with a slight lag, we must keep the possibility of a delayed cooldown firmly on our radar. So, putting all of this together, we have a broken downtrend, but a rally fueled by a derivative short squeeze against the backdrop of an election year liquidity injection. In the short term, the probability favors a continuation toward the $82,000 to $84,000 zone, followed by potential rejection. Pay close attention to candle closes and volume once we tap that resistance block. September historically brings seasonal headwinds for risk assets, and pre-election uncertainty will likely cap immediate upside. But once the midterms conclude, the stage is set for a powerful relief rally heading into October and beyond. Timing the absolute bottom is near impossible, but positioning yourself ahead of this major market shift is how you win. That wraps it up for today's video. If you found this breakdown valuable, hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next update. Thanks for watching, and I'll catch you in the next one.